Chairman Ben Bernanke promising that he'll do all that he can to boost a struggling economy. But Dallas Fed President Richard Fisher may not agree with doing more. He is one of the voting members on the Fed, and he voted against the chairman's latest policy moves. He joins us live from an economist meeting in Dallas, where Bloomberg's Sara Eisen is standing by. Sara?
Betty, and a special thanks to Dallas Federal Reserve President Richard Fisher, who got up very early, and he's going to be giving a speech here later at the NABE meeting of business economists, 3 p.m. Central Time. He's here to give us a little preview. So the recent slump in the U.S. economy, the question is, can the Federal Reserve do anything about it?
Well, just a correction to the lead in there, all of us, whether it's Chairman Bernanke or those of us that serve under his leadership, whether we are hawks or doves or whatever, however you might describe us using aviary terms, we're all trying to do the same thing, which is to find an answer to getting closer to better employment without giving up price stability. And we have a severe problem in this country, which is we have too many people unemployed, we have too much slack capacity. All of us are trying to find the right answer. So it's not one versus another. I think that's very important to understand. I'm going to talk this afternoon a little bit about this. I'm just going to give you a little teaser.
Good.
But I think it's important to realize that we're not the only actor in this important drama. There are fiscal authorities as well, and they've got to get it right. And as of yet, they have done more spreading of uncertainty, which inhibits the ability of the great amount of liquidity and accommodation we've provided to go to work. We provide the gas. Someone has to step on the gas pedal, engage the transmission, get small businesses and medium-sized businesses and large businesses to hire and put the American people back to work. The question is, what are the limits of monetary policy? I'll be referring to that this afternoon, and I'm not going to tell your viewers right now.
Well, give us a little taste, because you did dissent last time around on this.
That's right.
The commitment to keep rates super low through the middle of 2013.
Right.
Is it the inaction from Congress that caused you to dissent there?
That's part of it. The real question is, without that clarity, without seeing the eyes, which everybody wants to see, the whites of the eyes of final demand, what signal were we sending by saying that we would be committing to keeping rates exceptionally low, that's the language we used, perhaps out to 2013? Now, one argument, of course, is that that would liberate people to go ahead and proceed understanding we would have low rates. I don't think that's why people are not borrowing money right now. They're not borrowing money because they're concerned about final demand, that's pretty clear, and the European crisis has made that even more difficult to get that kind of confidence. But they're also deluged with uncertainty about everything from healthcare to how much they're going to be taxed, how we're going to correct our fiscal situation, and so on. So it might, I would argue, actually be an incentive to not borrow and not put that money to work, because you know rates are going to be very low out to 2013 unless the scenario changes. This is the nature of the discussions we have. They're not arguments, they're discussions. I think that's important to understand.
Mr. Fisher, right before the break when I was hearing you talk with Sara, and he was, you were saying, look, everybody within the Fed, and I understand that, are working to make sure that you can try to help and support this economy. But the issue is there any concern that the more dissenters like you get more and more attention in the public, that is going to make the job of Ben Bernanke even tougher?
That question was actually asked of Ben in Minneapolis last week of the Chairman Bernanke. And he rightly pointed out that that's part of the process. Our obligation is to do what we think is best. And I think it provides the markets with a glimpse of the difficulty of this decision making. The majority rules at the Open Market Committee. 3 of us dissented last time. Who knows what will happen at our next 2-day meeting. We're going to have to look at things very carefully and observe the inputs that we receive and make the decisions that we make. But I think it's a healthy thing, not an unhealthy thing. The drama comes from y'all and from the media that tries to make this into something that is contentious. It's not. It's just a serious discussion and trying to figure out what's wrong.
That's not really fair, because it's not that we're creating the drama. It's that, look, we want to know that our policymakers are all in line with what they want to do. And if there is dissent, and it seems growing dissent on the Fed board about what to do with monetary policy, that is a legitimate concern. It sends a mixed signal to the markets, and that is why you're seeing all this volatility now.
That's why we're seeing what? I'm sorry?
All this volatility in the markets.
I'm not sure that results from the 3 dissenters. We have volatility because there's an enormous amount of uncertainty. I spent my living building and running one of the first hedge funds in this part of the United States. I think I understand a little bit about markets. I started in 1974 and got out in 1997. It's a long time frame, longer than Sarah's been alive. So I think you have to be very careful about what you attribute volatility to, and I seriously doubt it has to do with the discussion we had at our last FOMC meeting. Having said that, I think it's important for us to communicate clearly what the people at the table feel. These are not haphazard decisions. They're seriously thought through, and we communicate as honestly as we can. That's the nature of the Open Market Committee.
All right, let's talk about some of those decisions. Charlie
Sure.
Evans, your colleague from the Chicago Fed, says
Good
we
guy.
need to see, good guy, but he says we need to see serious amounts of accommodative policy from here. Do you agree?
Well, I haven't agreed so far, because the question is, what effect will it have? But we'll see what happens as we go forward. Charles has a different viewpoint than I do, or has thus far. It's a question, again, of what we do with all that liquidity that's been provided to the system at very low cost. Money is basically free. The gas tanks are full. Who steps on the gas pedal? How do we engage the transmission? How do we get people to do that? Is it by keeping money available, more accommodation, and cheap? Or does something else have to trigger that reaction amongst those that hire people, which are private businesses?
Well, since we don't have that trigger, is the Fed policy right now doing more harm than good?
I'm not saying it's doing more harm than good. I think we have corrected for the lack of liquidity that existed during the crisis. But we want to make sure we're not pushing on a string. And I will be looking at, from my perspective, as one of the people sitting at the table, as one of the 12 bankers in the system, as to whether or not we can come up with something effective. All of us want the same thing. Whether it's Charles Evans or Richard Fisher or Ben Bernanke or anybody else, we want to make sure that employment increases here. Inflation is not the issue presently, and I'm a hawk. But the question is, what is practicable and effective? And that's what we should always be discussing, and we will.
Mr. Fisher, on the topic of inflation, do you agree with Bernanke that it appears that the inflation that we saw in the first half of this year appears to be temporary?
Well, being Texans and being from the Dallas Fed, we do everything differently here, and we measure by the trim mean PCE, the personal consumption expenditures. It rose in July up to a little over 2% from 1.4%. But we're beginning to see the 6-month moving average mitigate more towards the 2% level. The headline PCE is above 3%, as you know. Based on our own data, which goes back to 1978, it tracks 178 different consumer items. We constantly update this. We believe that this is a better forecaster of where things are going, as well as gives us a better insight into how this affects real people that actually consume. And based on that, and we'll see, but we expect the headline inflation rate to come down closer to the 2% we see on the trim mean. So we don't have dramatic amounts of inflation. I think we're trending more towards 2%, and I accept the chairman's arguments. I think he's right. Some of these influences were temporary. We're going to watch this very carefully, but our own data indicates what the chairman has been saying to the public.
Richard, I want to ask you, the Fed chairman says that there are a number of tools he has left. He laid out what they were. Would there be any one in particular that you would be in favor of using to ease further?
We're going to have a 2-day meeting coming up. We'll look at every possible tool in our toolkit, and again, try to determine what is the most practicable. First, should we deploy anything? Secondly, if so, what's the most practicable to deploy that will have the impact that we would like to have? And I don't think it's good for me or anybody else to comment before a meeting which ones we might contemplate and which ones we might conceivably use, or whether we'll use any at all.
All right, we want to ask you about Europe, front and center in investors' minds. How vulnerable is the U.S. banking system to a potential default in Greece?
Well, they are our largest trading partner, first of all, so there's that transmission mechanism. The question is how disruptive this is likely to be. I'm hesitant to comment on this because, again, it's a European problem. The ECB is at the center, the epicenter of all this. We know what's happening in Greece over the last few days and what's happening to the widening of spreads for French and other banks. I don't think it's appropriate for a U.S. monetary official to comment on this.
All right, Betty, there you go. Richard Fisher, the president of the Dallas Fed.